against unpredictable price fluctuation. This reduces the risk of price changes between now and the delivery date. This allows businesses to lock in a minimum price for their products if they're selling, or it could put a roof on the maximum price they're willing to pay by locking in the price now. So this allows greater flexibility and gives the business some semblance of stability into the future. Have you ever wished for a crystal ball to predict the future of market prices? Futures is a way to achieve this. Futures contracts are the next best thing, serving as financial safeguard against volatile price movement. It is akin to financial armor, protecting your businesses from unexpected shocks. If you're a business, have you ever considered how hedging could secure your operations? I'm curious to know. Is anyone watching this video a business that uses futures contracts as a hedging strategy to limit losses, lock in some particular price in the future, or any other way a business might use a futures contract? I'd be interested to hear about it if you let me know. Liquidity. Many futures contracts, such as those for commodities like oil or financial instruments like the S&P 500, are extremely liquid. This high liquidity makes it easier for traders to enter and exit positions. Picture high liquidity as an open, free-flowing river, permitting smooth and swift transactions. Some futures contracts, like those for commodities and major financial indices, offer this advantage. With the ability to jump in and out at your leisure, how might this fluidity transform your trading strategy? This liquidity of the futures contracts is because all futures contracts are standard. The futures market uses standardized contracts. This means that the specification for each contract, such as the quantity of the underlying asset, the delivery date, and the price increments, are all set by the exchange. This standardization makes the contracts interchangeable or fungible, and thus much easier to trade. Because you could always trade like for like. They are completely fungible. 24-hour markets. Many future markets operate nearly 24 hours a day, which can be attractive to traders as it allows them to react to global events and changes in the markets immediately, rather than waiting for markets to open. The sun never sets in the futures trading world. Thanks to the near constant trading windows, when global events cause market tremors, you can respond instantly. How could a 24-hour market cycle empower your trading decisions? Do you see any downsides associated with a 24-hour market? Speculation. For those inclined towards speculation, futures offer potential for substantial returns. Because of the leverage involved in futures trading, traders have the opportunity to make significant profits. If their predictions about future price proves correct, then they can make a lot of money very quickly. For those who find a thrill in taking calculated risks, futures trading provides an exciting platform for speculation. Can you navigate the roller coaster of market predictions and turn volatility into victory? Speculation is essentially the practice of making directional bets on the future price of an asset, with the aim of profiting from price changes. In the context of futures trading, a day trader can use speculation to potentially generate substantial returns within a relatively short period of time. A few benefits of speculating on futures are potential for quick profits. Due to the fast-paced nature of day trading, speculators can potentially make significant profits within a single trading day if their predictions are correct. No ownership required. With futures, you're speculating on the future price of an underlying asset without needing to own it. This means you can speculate on price movement in either direction, up or down, without holding for delivery. Now, while these are some of the benefits of speculating, there are also some downsides. Here are a few downsides of speculating on futures prices. there's always the potential for a large loss. The same leverage and span margin that can amplify your profits can also lead to significant losses. If the market moves against the trader's position, it is important for day traders to use risk management strategies, such as a stop-loss order, to protect themselves from even greater losses. Day trading futures requires significant skill and knowledge. Successful speculation requires a deep understanding of the markets and the ability to analyze a variety of information quickly. Without this, a day trader is essentially gambling, which can lead to substantial losses. Emotional stress. Day trading can be highly stressful, particularly when speculating on high-risk, high-reward trades. This emotional toll can lead to poor decision-making and ultimately trading losses. Overtrading. The potential for quick profits can lead to overtrading, where traders make more trades than they probably should in the hopes of achieving greater profits. This can increase transaction costs and potentially lead to poorer trading decisions. Diversification. Futures can provide an additional layer of diversification to an investment portfolio. Because futures contracts are derived from a wide range of underlying assets, they can help spread out the risks of these underlying assets. Imagine your portfolio as an art piece and futures contracts as splashes of vibrant color, adding complexity and depth. They disperse risk and help make your financial standing resilient. Could a touch of futures trading be a key to perfecting your financial masterpiece? Transparency and price discovery. Futures markets are known for their transparency. The prices of futures contracts are determined by supply and demand dynamics. In the market, the price of futures contracts are determined by supply and demand dynamics in the markets and are considered to be an indicator of the expected future price of the underlying assets. In the open book of futures markets, every page is available for your perusal. This visibility provides a fair and even playground. Do you see yourself striving in such an upfront and straightforward environment? Let's talk about leverage risk. Leverage can amplify both profits and losses. A small price change in the wrong direction can result in significant losses, possibly exceeding the initial investment due to the high degree of leverage involved in futures trading. Leveraged trading often involves borrowing capital to open positions. If the market moves in the wrong direction and your account balance falls below a certain threshold, you'll face a margin call. This means that you must deposit more money or close out your positions to meet the margin requirements. Ever had to suddenly come up with cash for an unexpected expense? Margin calls are the trading equivalent of those, and they can force traders to make hastily suboptimal decisions, which, if you had proper risk management or enough capital, could have gone in your favor. So it's important to remember, avoid margin calls at all costs. Have you ever been in a situation where you were faced with a margin call? What actions did you take when you were faced with a margin call? Looking back, would you handle the trade any differently that caused you to have a margin call based on your experience? Another pitfall of leverage is that leverage